Hey guys, Freaky Finance here. Last week we looked at Kinross Gold, and this week we're going to look at Salem Media Group. This company is a very small company, small market cap. It has 3 divisions, and it's Christian broadcasting. It's kind of more on the political spectrum, definitely more on the right-wing side. I'm not political at all, I'm not even American, but it does trade on the NASDAQ under the ticker SALM. But anyway, let's get into it, because I find this company pretty fascinating. Salem Media Group, so 3 divisions: broadcasting, so your traditional radio, digital, that's where the growth has been lately. We're seeing that in podcasts, and we're seeing that just online in general, starting to tick up for these guys. Then they have publishing, which is a little lumpy, and it kind of goes in line with big political events. So like the presidential election and stuff like that does really well during that period of time. Anyway, they've been around for a while, right? 1974. They used to be a Christian teaching and talk radio station. They went public in 1999. So there's quite a lot of history on them trading on the NASDAQ. It's pretty interesting, right? 98 radio stations. And they do have some pretty high-end websites for, it's not quality-wise, but traffic-wise. Radio broadcasting is still by far the dominant new line, and you can see it split out mainly between 2. So you have advertising, which goes up and down with people spending more in general on ad dollars. So during the COVID, the initial panic, advertising got slashed pretty hard by a lot of companies all at once. So this company suffered during that, I want to say March to early June. But we saw advertising pick back up for a lot of things lately. And then programming also is more stable. So this is kind of like your stable cash flow. This is like if the economy is doing good cash flow. Then you have this thing, which is just growing because digital media is growing. Like I've never actually done a video on podcasts, but I did own iHeartRadio for a bit. And the whole reason behind that was because of the podcast generation. And I think that's a hidden strength of this company. And then you have book publishing. Like I said, it's kind of lumpy. They do self-publishing, and they also have traditional publishers. So where it ranks in terms of the broadcasting spectrum, it's actually pretty high, right? So you have iHeartMedia, and then Salem is just number 3. So not bad, eh? According to, again, these are their slides. But their footprint's pretty large, so you have pretty much up and down the coast and then the Bible Belt. And that's pretty much what you'd expect. I mean, they're obviously targeting some strategic areas where there's high population, so you get the most listeners, right? And they got quite a lot in California, quite a lot in Texas, quite a lot in Florida. But honestly, they're all over the place. A couple AMs in the heartland. So one of the things that's nice about the programming is that you kind of get these renewal rates. Once you decide to advertise with these guys, they tend to stick with them. And the company usually gets about 2 to 3.5% rate increases each year, which is nice, right? So you're slowly always making more money and hedging that inflation risk, right? Because you're slowly just increasing your prices for your broadcasting. Yeah, they got a long track record, so a lot of programmers, and that's kind of what you've seen on the conservative side, right? I think is a lot of these radio guys are getting up there in years. 29% of total revenue is programming revenue. So, and that's your steady cash flow. And you can see that here, reference and network revenue. You can see it just slowly trailing 12 months, just keeps slowly going up, right? And that's what you'd expect. You don't really get the diversity. There you go, there. But yeah, again, I don't listen to any of this, so I can't speak to the quality. Digital broadcasting is an exciting one, so you can see the last 12 months trailing year-over-year comps are just amazing, right? And they keep launching new things. So they launched Salem Surround in 2018. You can see that pick up from 1.1 to 7.6 to 8.7 these last 12 months. But even their banner ads just keep doubling every year. Well, not doubling, but 100%, 50%. It's going up by about $4 million a year, which isn't small for a company of this size, right? But the main things that I'm excited about are now they have Salem Now, so they have video on demand, which is kind of interesting. It's not huge or anything. I haven't checked out the platform. And then you have Salem Podcast Network as well, which is just started. Launched in Q1 2021, so that's, what is it, August, so 7 months ago. I think that's just going to continue to grow materially. And then on the book side, you kind of have this, like I said, the lumpiness. You have their own publishing line, then you have their self-publishing services where people can just publish their own books. So let's get into the financials. One of the things you're going to notice, and it's probably the only thing I don't like about this company, is the debt load. Right down here, you can see long-term debt. The right column is actually the current as of June 30th, 2021. I usually like to lead left to right, it's backwards for me. So one of the things that's interesting with this company on the balance sheet, so I like to start there, is the long-term debt. So that's the part I don't like. And you can see it is fairly indebted. For reference, the market cap of the equity market cap is only about 70 million, maybe 75 now. It kind of shot up lately. I do own this one. And yeah, recently it just shot up a bit. I'm not sure why. Well, there's a news release on Friday, but not in this one in any size or anything. It, like I said, it's very small cap, which have been a place to place of pain for the last really 3 months anyway. But you can see the market cap's only 73 million on the equity side. And the long-term debt, like I said, is 225. Total, just say total EV is 300 million, right? So really they're trading at 10 times EV, or 10 times EBITDA in terms of EV. So, but this thing is a cash machine, so the debt's technically not a problem as long as it's not all due at once and they can roll it, which they probably will be able to do because their underlying cash flow is actually pretty strong. So in terms of strength and weaknesses, the balance sheet is probably the biggest weakness. A lot of their assets are tied up in broadcast licenses. They do have a decent amount of PPE, which we'll talk about in a bit. 19 million in cash isn't small. Like I said, the equity market cap's only 74 million. So this company trades pretty cheap in terms of the equity value, but the reason for that is the debt load. But anyway, the income statement, you can just see the segment breakouts year over year for 6 months and for 3 months. And you can see the company has pretty much recovered from the COVID panic, at least in Q2. And you can see there's also a decent amount in depreciation and amortization for this company, right? 32, so 3.2 million in a quarter, which isn't a small amount. They do pay quite a bit of their operating income and net interest expense, which is what you'd expect when you have 225 million in debt. So anyway, they make a decent amount in terms of earnings per share, but really you're buying this for the cash flow more than you are for the earnings. One of the things that really excited me on the news release when I went to the quarterly is they sold some land. So this won't show up in the quarter because it's after the quarter ended June 30th. So July 23rd, they sold this 34 acres of land. And this is something new. What a lot of companies that own tower sites are doing is they're selling off the land they don't need and just keeping the tower part that they do need for their business. And it's freeing up cash flow, which they can then use to pay down the debt, which is the biggest problem with this company. And this was interesting. So they sold it for 12.1 million in cash, right? And the company will retain enough property in the Southwest corner to still operate. So that's what you'd expect. They're going to get this 12.1 million in cash, and then they're going to hopefully they're going to pay down debt. One of the things that's interesting is when I go to the land, you can see on their books, they only had 30 million. So this is now on the annual. So as of the year end 2020, they only had 30 million booked in land. I haven't really gone through accounting for PPE, but basically all the things underneath that depreciate at set rates. Say buildings will depreciate slowly at say 2% a year, whereas other things will depreciate say at 30 a year, and then say software will depreciate at 100% a year. And if you're not familiar with terms for depreciation, you probably will be, because by now I use them probably every video I do. But basically, just think of your automobile. When you buy it for a new vehicle, say for 20,000, you're not going to be able to sell it 5 years at 20,000. It's going to depreciate the value over time, and that's what a lot of assets do. They depreciate. However, land is booked at the cost value, the initial cost value. So say if I buy land for 2 million, it's going to stay on my books for 2 million unless I have a reason for impairment. And then when I go to sell the land, that's when I book the gain. So say if the land's now worth 4 million, because land generally appreciates over time, I can book the gain. So yeah, the main thing with land usually just has a very low carrying value relative to its current market value, because it's usually held at the original cost. So it's not appreciated or depreciated, it's just usually stuck there until they sell it. And usually it's at a gain, and then you have to factor in what their carrying value was on that piece of land, and then what's the after-tax effect, right? But anyway, it's kind of the angle. So I'm like, well, if they sold one site for 12 million, but they only have 30 million on the books, and I know they own a land of 44 tower sites of their 89 tower sites, so they lease the other ones. So they own about half of the land. How much of value is hidden underneath these tower assets, right? And the land value, if one is worth 12 and they only have 30 million of land booked on the books in carrying value. So it's like, Now, I was trying to dig deeper to see if I could find a list, but I couldn't find one, at least readily. So that'd be nice if they're trying to maximize shareholder value. I think that'd be a way to do it, is just list the tower assets and their current land value. They don't even need to give an estimated market value, just what they currently have. Those lands at the carrying value, right? That could be interesting. Or maybe even just list the ones that they're thinking about selling. Pretty interesting angle there, because like I said, the biggest risk is the debt, and if this is a way to increase cash proceeds to pay down the debt, assuming that's what they do with the cash proceeds. In terms of ownership for this company, it's very small, so you wouldn't expect very many big guys in this. Like I said, the equity market value is only 75 million now, and I think yesterday it was under 70. So the CEO owns about 16% of the company, which is always a good sign. So there's some insider ownership, not institutional. I doubt any institutions could be in this company in any meaningful way. Anyway, so who's this guy? So he's a co-founder from the original days. He is the brother-in-law of the other guy, the other co-founder. In 1972, he has a master's. Interesting accolade. Yeah, anyway. The quarterly, so this is just the history of the last 4 quarters. And you can see the effect on COVID during March. And between March and June last year is pretty bad, right? So you went negative EPS, and your revenue went from 64 million all the way down to 52 million technically. Their staff, they did ask them all to take pay cuts and stuff like that originally. So we saw that they kind of protected a little bit of gross profit, but not enough. But lately it's bounced back pretty hard, right? And now they're allowing their costs to come back up a little, and the pay cuts that people took to come back as the business has normalized again. So that's good. That means it's prudent. They respond to stress, and I think that was a smart move. And it's also nice because the share-based comps aren't very high, so they're not paying themselves an obscene amount, right? So anyway, the last 4 quarters, trailing 12 months, you can see that's 22 cents in earnings. Not, again, this isn't technically an earnings play, but say if the stock would closed at 275, so 275 into 22 cents, right? So and you're sitting at 12 and a half times earnings. But I mean, just a couple days ago, this thing was at $2, right? So you're less than 10 times earnings. So the small caps right now are pretty crazy. Things are going up and down 5% a day right now. It's an interesting time. Anyway, the main line for me is the EBITDA line. You can see the last 4 quarters, they've been 8.3, 9.9, 7.7, 9.4. So pretty strong EBITDA when the market cap is only 75 million, right? Let's just call this 18, 25, 36. Now, one of the things that they've guided down the next 2 quarters relative to prior year because they had a strong political environment, right, with the election. So their publishing business did very well, and their online business with some specific websites did very well. So they're not expecting that to repeat. So they're expecting these EBITDA numbers to fall off in this next 2 quarters. This hit the news wire on August 12th. It's another newer person, a younger person coming in. Another broadcaster, like when we looked at those little broadcaster images, you saw it was a lot of older dudes, a lot of older white dudes. So they're bringing in younger people, and I think this is important because it's going to line up with the podcast and digital theme that we're seeing pick up, right? We looked at this slide. It shows you that just the strength and growth in the digital broadcast revenue, just how quickly that's growing, and I think that's not really appreciated in this asset base. Before we go to the chart, let's go through the call notes. This one is just on the land. Again, he's saying, hey, we sold it for 12.1 million, no loss in coverage, no loss in revenue. Didn't really talk about, but they're putting some cash to work on the online, so that's what you'd expect. They're investing in the higher growth areas, so we'll have to see if these are prudent or not. So far, they have been prudent, and I think going digital is very important, especially when you already have the broadcast. You can get the word out on your digital platforms pretty quick, right? And you can link them up and start generating some traffic there and more ad dollars. Leverage ratio was the biggest weakness, so that actually hit almost 9 times leverage. But again, that's distorted by COVID impact because we saw how bad the quarters were for those. And they did have 260 million in bonds outstanding as of June 30th. I thought this was interesting. So the PPP loans, they took 11 million worth. It was all forgiven, so they must have used it for payroll. All forgiven except for 20,000. So basically, it was all forgiven. Surprised they even broke that out. And they do have 20 million in cash. Our leverage ratio was 6 at the cash on hand and reflect the forgiveness of the PPP loans. So that 11 million that's about to be forgiven in this next quarter. And then the leverage ratio would have been 5. And then if they add in the cash that they got from the July Dallas land sale, their leverage would be a little 5. So that's pretty crazy, right? That these small numbers, because this company is so small, these little 11 million here, 12 million here, they really impact the leverage ratio of this business. So now you're back down below 5. And that's where the company was historically around 5. So their guidance for the 3rd quarter, they didn't give one for the full year. Basically, they kind of do something where they don't give you the number. They give you the last year's number, and then they give you the growth rate. So you just take the last year's number and multiply it by the growth rate. So I had to take the midpoint. So they said they'd grow between 3 and 4. So I just took 3 and said, okay, that revenue is going to be 62.4. And then here they did the same thing with expenses. So I just took what they did last year in cost, times it by 9%, and you're at 55. Now, one of the reasons why the cost is outscaling the revenue in a specific quarter is because the expenses were artificially low Q3 last year because of the pay cuts. So they've reversed some of the pay cuts to pay people better wages they had before because the business has bounced back. So anyway, Q3 EBITDA, I'm looking at 6.8, so not as good as last year's EBITDA. So I'll have to say the market handles that noise. Technically, it should be priced in, but these things usually never are. Should see a slowdown. Maybe I get it cheaper again, but lately it's just been blasting off. But yeah, likely hitting 27 or 30 million in EBITDA in this fiscal year end, which is pretty crazy. Like I said, the market cap's only 75, so you're trading just a little bit over double, 2.5 times EBITDA. in terms of equity market cap. But again, the debt is the driver there of the discount probably. So if they pay off the debt, I think this equity is going to re-rate higher over time. This is them saying, one of the analysts was like, well, your expenses are going to increase 9% versus last year's quarter when your revenue is only going to grow 3 to 4. What's going on? And basically they said what I said. They were tight on expenses last year because of the revenue being slashed, because ad dollars were being slashed during the COVID panic. And so they took pay cuts, and now they've restored them, which I think is good. So publishing, like I said, is going to be lumpy, and that's why I think this back half, this Q3, Q4 is going to be weaker, because last year they had the election. I did think this was interesting that they're like, yeah, we're going to be relatively quiet for the second half of 2021, and there isn't really a breakout title in the second half of this year, so we're more focused towards 2022, and they have the midterm elections that year. So David Limbaugh, so Rush Limbaugh died, right, I think in February. I will talk about him in a second, because this somehow ties into this company as well, which is kind of interesting. There's a little bit of rabbit holes on this guy. It's kind of fun to go through, honestly, if you have time. Anyway, so they said this publishing schedule coming together very nicely for 2022, so we might see a slowdown these next 5 months, and then you see a pickup in 2022. While at the same time, you have this consistent growth in digital, at least over a longer time series. This one, so your total debt, how we account for this PPP forgiveness, which I thought was interesting. So you could take this to other businesses as well, because basically when it's forgiven, this guy's saying, we don't think it's taxable gain. That makes sense. The government's giving you money, and then if they forgive it, then you have to pay tax on it. That wouldn't really make sense. What they're doing is saying is basically going to go below the line. We should see this weird other income line in the next quarter. We should see a weird $11 million on operating gain from PPP forgiveness, I guess, underneath the operating line anyway. Pretty interesting just to think about. So that might distort the earnings per share anyway next quarter. This one I thought was interesting. So I'm like, one of the risks that could happen, like right now I'd prefer them to pay down debt with the cash that they're getting, right? Both from organic cash flow, but also from these land proceeds. And this question is good because he's asking, hey, are you going to buy back stock? Because their stock is very cheap technically, because it's got smashed from COVID and hasn't really recovered. Well, it started to recover, but it hasn't gone close to what it used to be. So he said, yes, buying back stock is a rejected payment under our covenants. So we have some ability to do it. So basically, this is the creditor protecting itself, saying, you got to pay me back first before you reward your common shareholders. Though in this case, because the company is so indebted, I think paying back the debt actually benefits everybody, including the common shareholders. And because the interest expense is so high, it kind of eats into the EPS anyway. It just makes sense. So this actually makes me happier that they're stuck paying down debt, because that's the biggest problem for me for this company. I've kind of harped on that enough probably. This last question, so this wasn't from the most recent quarter. They just posted in August, early August. This is from the March 30th quarter end. Anyway, this one was about Rush Limbaugh and picking up some spots, and he's like, yeah, we've actually had our younger guy, Charlie Kirk, show in particular pick up a couple strong new affiliates in New York, and that was really the debut station of Rush Limbaugh, so we see a great opportunity. So this company is slowly taking more and more market share from that kind of mind share group, that kind of demographic. And I think that demographic is also very easy and niche to market to. So I like this setup. I mean, it's never good to celebrate someone dying, but I think this company stands to benefit from that, just from the shift, because that guy was fairly well known. Anyway, I'm not political or anything like that. I just try to make some money. Anyway, you see the COVID panic. This thing got hit down to 80 cents. Right now it's at 2.75. But I mean, this thing swings was at $2 just 3 weeks ago. So that's at almost a 50% return in 3 weeks. That's how much this thing is moving. But you can see relative to where it used to be just in 2015, 2017 even, this thing was at $7 instead of 2. And this thing was in decline because of the debt load, I think, during 20 as well. And recently it started to bounce back. Then look at the prior recession. You can see that this thing was in similar straits. They hit around 50 cents and then shot up to $5, so a 10x in a year, which is pretty crazy, right? Shows you that this thing gets punished real hard and then it swings back up real hard. And I think that's a function of leverage as well, and the perceived risk of bankruptcy or not. But anyway, you can see 80 cents, 2.75. This thing could swing easy back to $8, especially if they fix the balance sheet. That would be unlocking some pretty good value here. I do like to see like what was the financials like during the period where it was decent. So 2014, 2015, 2016, you can see the EPS was never crazy high. I mean, it did hit almost $1, which is pretty high for this company, especially when it's currently trading at 2.75 shares. But you can see usually around this 30-40 cent range, 20 cent range, and it was getting rewarded pretty well relative to where it is now. You look and you're like, okay, that's between value previously was between 10 and call it 5. really in that range for that period. And now we're back in that 20-cent EBITDA range, and we're still down in this $2 land. And we got a lot of good news to start deleveraging the balance sheet coming up. And I also like that the organic cash flow's there, so I don't have to worry about bankruptcy, assuming they don't shoot themselves in the foot or something. But yeah, anyway, that's Salem Media Group. It's a small cap play. It's a deleveraging story, and they have a steady stream of cash flow. Might be some weakness in the next 2 quarters. Again, we'll have to see because they're doing a decent amount of deleveraging this next quarter, which I think should unlock value. But if it doesn't, I'm probably going to buy more into this in 2022, especially if they ever give guidance, like real guidance. So anyway, I'd like to know your thoughts on this one, and have a great rest of your week.